All right, grab your notebooks. Welcome to this explainer. If you've been staring at financial statements and feeling like they're just, a bunch of random numbers written in a totally different language, take a deep breath. I'm your personal tutor today, and this right here, this is our final exam cram session. We're going to completely demystify the core foundation of modern accounting. By the time we're done, you're going to see exactly how all these numbers piece together like a giant, perfectly fitting puzzle, every single time.
Okay, so here's our syllabus for the cram session. We've got 1. The Golden Accounting Rule. 2. Household Vocabulary. 3. The Double Entry Balancing Act. 4. Step-by-step manual calculation. And 5. Judging a company's health. We're breaking the whole shebang down into simple, bite-sized pieces, so don't stress.
Let's kick things off with part 1, the Golden Accounting Rule.
And here it is, the formula that literally runs the financial world. Assets equals liabilities plus shareholders' equity. Now, I want you to imagine a perfectly balanced seesaw on a playground. On the left side of that seesaw, you have your assets. On the right side, sitting together, you've got liabilities and equity. For a company's books to be right, this seesaw can never ever tip. That left side absolutely must weigh the exact same as the right side. It totally dictates a company's entire financial position.
Moving right along to part 2, Household Vocabulary. Let's translate this corporate jargon.
First up on our vocab list, assets. Now, in the corporate world, assets are valuable resources a company controls that benefit them now or later. We're talking liquid stuff like cash or fixed things like massive factory buildings, machinery, and inventory. But let's bring it down to earth, to your own house. Your assets? They're that $20 bill sitting in your wallet right now. It's the laptop on your desk. It's the car in your driveway. Basically, it's just stuff of value that you own and control.
Next, we have liabilities. These are simply the debts and costs a company has to pay to keep the lights on. For a business, this means massive bank loans, deferred revenues, huge payrolls, and corporate taxes. But let's look at your own life again. Your personal liabilities? Well, that's that nagging student loan you're paying off every month. It's your monthly credit card bill, or the rent and utility payments coming due. Basically, it's any financial obligation where you owe someone else money.
Finally, shareholders' equity. The easiest way to wrap your head around this is to realize it's what's left over if a company liquidated, meaning they sold off all their assets and paid off every single debt. It also includes something called retained earnings, which, honestly, just think of it as the company's savings account for future use. So back to our household analogy, imagine you own a house worth $300,000. That's your asset, right? But you still owe $200,000 on the mortgage. That's your liability. If you sold that house and paid off the bank, you'd have $100,000 left sitting in your hands. That remaining $100,000? That is your equity. It's the piece of the pie you actually own free and clear.
All right, Section 3, the Double Entry Balancing Act. We've got our seesaw, right? Now let's see how the system actually keeps it totally level whenever a real transaction happens. Let's say a business goes to the bank and borrows a cool $1 million. On the left side of our equation, the company's cash goes up by $1 million. Boom, an asset increases. But wait, the seesaw has to balance. So at the exact same time on the right side of the equation, the company's bank loan goes up by $1 million. That's a liability increasing. Left side goes up, right side goes up by the exact same amount. Perfect balance. This is exactly why they call it double entry accounting, because every single move affects at least 2 accounts.
Now you might be wondering, what if everything happens on just one side of the seesaw? Check this out. Say a business buys a bunch of raw materials, and they pay with cash. On the left side of our equation, the company's inventory, which is an asset, goes up. But they paid with cash, right? So their cash, also an asset, goes down by the exact same amount. The total weight on the left side of the seesaw doesn't change one bit. +1 minus 1 equals 0 net change. The equation just effortlessly handles those one-sided shifts, keeping the whole system standardized and completely foolproof.
Okay, moving into Section 4, step-by-step manual calculation.
Grab your mental calculators, because here is your strict 4-step study guide for figuring this out manually from any balance sheet. Step 1. Locate the company's total assets for the period. Step 2. Find and total up all the liabilities. Usually they're sitting in their own section. Step 3. Locate total shareholders' equity and add that number right onto your total liabilities. And Step 4. The big verification. Check that the number you just got in Step 3 perfectly matches those total assets from Step 1. Let's do a practice run. We're looking at a big retailer, let's just call them XYZ Corp. So checking their balance sheet for the fiscal year, they've reported massive total assets of $170 billion. That right there is the left side of our seesaw.
Now let's build out the right side. XYZ Corp reported $120 billion in total liabilities. They also reported $50 billion in total shareholders' equity. So we do the math. 120 billion plus 50 billion, and look at that. We hit exactly $170 billion. Those total assets are perfectly matched by the liabilities and equity combined. That, my friends, is the accounting equation in action.
Okay, but let's step out of the practice room for a second and look at the real world. Take ExxonMobil's balance sheet data from March 2024. They reported total assets of $377,918 million. I mean, that's astronomical. This is literally one of the most complex, massive, global corporations on the planet. But guess what? The math, it does not change.
Here, let's prove it. We take ExxonMobil's total liabilities of $164,866 million, and we add their total equity of $213,052 million. The result, you guessed it, exactly $377,918 million. Left side matches the right side. Every single dollar of those massive assets is accounted for by either a debt they owe or equity owned by the shareholders, without fail, every time.
All right, final stretch. Section 5, Judging a Company's Health.
Now we stop acting like calculators checking for basic errors and start thinking like savvy investors. So the absolute crucial question is this. Okay, the balance sheet balances, but is the company actually healthy? This is the major limitation you absolutely must know for your exam. The double entry system guarantees the math is right. The seesaw is always going to be level. But a perfectly level seesaw doesn't automatically mean the business itself is doing great.
As an investor, you've got to look way beyond the perfect balance and really interpret what those figures are telling you. First off, look at the ratio. Does the company have way too many liabilities compared to its equity? Like, are they basically drowning in debt just to keep the lights on? Then analyze the assets. Do they have enough liquid assets, like cash, to handle an emergency, or is all their money tied up in massive factory buildings? You have to evaluate their financing to see if they're actually set up for long-term growth. The equation just hands you the numbers, but it's up to you to uncover the real story.
I absolutely love this quote from our source text because it really hits the nail on the head. The balance sheet always balances out, but the accounting equation can't tell investors how well a company is performing. The double entry system is vetted, it's standard, and yeah, it's basically foolproof for keeping the books. But guys, it is only step one. It's the starting line for true investment analysis, definitely not the finish line.
And just like that, we've hit the end of our cram session. You've officially aced the basics. You know the golden rule, the vocab, the balancing act, and exactly how to check the math. But I want to leave you with a bit of a provocative thought as we wrap up this explainer. If perfectly balanced books can still hide a failing business, what other clues must an investor look for next? Think about all the stuff that happens outside the balance sheet. Cash flow, market trends, leadership. The accounting equation is the foundation of the house, but to truly know the company, you've got to look at everything built on top of it. Keep studying, keep asking those big questions, and I'll see you in the next explainer.